Hi, my name is Joe Fennick, and I am the founder of GenOp Capital Management and Chief Investment Officer of the GenOp Financial Fund, an equity long-short hedge fund established in late 2020 with a focus primarily on the bank sector. I wanted to introduce you to our firm, but more importantly, in light of recent events surrounding the banking industry, I also wanted to share our perspective on what's happened and where we think we go from here. This is a time of confusion in the sense that the issues that have driven this crisis are very complex, even to many bank industry insiders, at least judging from the questions we've been fielding from bank boards of directors and bank management teams we've been asked to share our thoughts with over the past few weeks. So my goal here is to distill these complex issues down to a very basic level. And after listening, if you'd like to discuss in more detail, we can be available anytime to do so. So let's start with the very basics of what happened. 3 banks failed due to what we would consider to be a perfect storm of events: Silvergate Bank, Silicon Valley Bank, and Signature Bank. What I think has been missing from the commentary in the media so far, and that is very important in understanding what happened, is the fact that these 3 banks shared very unique characteristics, and those characteristics are not shared by very many others. Now, before we get to the linkage between those 3 companies, I think it's also important to point out that issues in Europe, specifically around Credit Suisse, we think were aggravated by, but are pretty much otherwise mostly unrelated to the challenges with the 3 failed banks in the US. And that's an important point, because I think the issues with Credit Suisse furthered this perception that this was a systemic issue in the global banking system, when in fact, we and others have flagged Credit Suisse for over a year now as a potential problem. So let's talk briefly about these 3 banks, why we think they are very much linked together, and why that's important. Silvergate Bank was the leading bank focused on the crypto economy. After the collapse of FTX in November, Silvergate lost about 70% of their crypto deposits. And remember, crypto was the entire deposit base of the company. These crypto deposits were invested in longer duration securities, and those securities had lost significant value as interest rates increased. So when those crypto depositors withdrew their funds after the collapse of FTX, Silvergate was forced to sell these securities at a discount to fund the outflows of customer deposits. I think the perception at the time, and this is important because it's why the issues with Silicon Valley Bank weren't flagged in the media, the perception at the time was that FTX caused the demise of Silvergate Bank. But in fact, it was the inability to fund the deposit outflows due to the impaired value of the securities that were sold to meet that depositor demand for their funds. So moving now to Silicon Valley Bank, deposit outflows, as has been the case for most banks to this point, deposit outflows were due in part to increases in interest rates, as customers sought higher yielding alternatives in a higher rate environment. But layered onto that were deposit outflows related to the struggles of the startup tech community. Now, these outflows were not nearly on the scale as what we saw at Silvergate, but just like with Silvergate, Silicon Valley Bank had a long duration investment securities portfolio that had significantly declined in value. At the same time, well over 90% of their deposit accounts were uninsured, leading, I think, many people to question the safety of uninsured deposit balances everywhere. Now, with Signature Bank, that company had increasingly in recent years catered their business to the crypto community. So as was the case with Silvergate, after the collapse of FTX, they started to bleed crypto deposits and then announced that they would significantly scale back their crypto business. This wasn't quite as immediately devastating to Signature as it was to Silvergate, because as I mentioned earlier, Silvergate's entire business model revolved around the crypto economy, whereas at Signature, it was a significant piece of the business, but behind that was a very large and well-established and more traditional bread and butter banking business. However, that traditional banking business did target customers that tended to maintain deposit accounts well in excess of deposit insurance coverage limits. So you can see, hopefully through that explanation, how a perfect storm of events can catalyze catastrophic problems amongst a group of banks with the characteristics I just described. namely 1, a high percentage of uninsured deposits, 2, a tech or crypto deposit focus, and 3, liquidity challenges with a high concentration of securities that had lost significant value. So then the logical next question, I think, is, well, how many other banks have that unique combination of similar characteristics? The good news is not very many at all. And in our estimation, no banks that are characterized as systemically important sport those three characteristics in the aggregate. And that might be the most important takeaway, I think, of this whole situation, because people are drawing parallels to the Great Recession of 2008, which on the surface would seem to make some sense. But that's where we very much disagree. I was a research analyst following the bank sector during the events of 2008 and immediately afterward. The difference is that as events unfolded at that time, it was abundantly clear that there were hundreds of banks at risk. And right at the top of the list were a majority of the banks that we would now deem to be systemically important. Think about how many banks had the combination back then of toxic securities, poor underwriting, and catastrophic loss exposure on their balance sheet from the real estate meltdown, and layered onto that inadequate capital. So that very long list of banks exposed to the real estate crisis in 2008 stands in very stark contrast to the very short list of banks that have similar characteristics to the ones that have failed so far in this cycle. Now, none of what I just said is meant to suggest that the current situation is any less worrisome at the moment. You know, whenever you're in the midst of what can only be described as panic within the banking system, it's a serious problem. Because if this panic is not resolved, what happens is that you're now facing the threat of engulfing a much larger subset of banks that may only exhibit one of the characteristics of the three banks that failed. So for instance, there are banks that are ensnared now in this crisis solely due to the fact that they have a high percentage of uninsured deposits, but have nothing whatever to do with tech or crypto, and they have minimal exposure to issues in their investment portfolio. But in our opinion, that's just simply a function of a panic that results from a general lack of confidence in the banking system, rather than, as was the case in 2008, a systemic fundamental flaw in the risk profile of hundreds and maybe even thousands of banks. That is a key difference in my opinion. So if this doesn't resemble 2008, breaking out our banking 101 history textbooks, what does it resemble? And in my opinion, it more closely resembles the bank panic of 1907, which was a very, very serious but ultimately short-lived panic that arose similarly to today from issues within a small subset of banks and then broadened out into a bank run as public distrust of the banking system began to take hold. The situation in 1907 was resolved when J.P. Morgan, the actual person, not the company, stepped up along with a consortium of prominent bankers and financiers to help end the panic. And we're seeing sort of echoes of that same sort of resolution starting to form as we speak today. That type of solution wouldn't have been possible in 2008 because of the deep-rooted fundamental issues I mentioned earlier. So at the end of the day, there will no doubt be consequences from this crisis, including some negative consequences, but I think it's more likely than not, as confidence in the banking system is restored, the panic today could be resolved relatively quickly. On a longer-term basis, I think the picture is even more encouraging for a few reasons. First, bank stock valuations are trading near historic low levels. And if history's taught us anything, it's that an investment in the bank sector before you have perfect clarity on the resolution of the crisis situation tends to represent an excellent entry point. Second, looking beyond the panic, we believe the bank sector will continue to consolidate. There are just over 4,000 banks in the United States today. There were over 11,000 when I started in the business 2 decades ago. And we think that number will be cut in half again over the next several years. There's been a building backlog of consolidation candidates too, which reflects, I think, the lack of activity, the lack of M&A activity during COVID, and then again last year and so far this year. And if you look at that universe of potential sellers, this crisis has eroded the takeout premium in virtually all of these stocks. So the baby's been thrown out with the bathwater, as they say, and these consolidation candidates can be bought at record low valuations along with the rest of the bank sector today. Third, some of the causes of this crisis for certain banks are being resolved through the market's response to the crisis itself. So for instance, interest rates have declined since the failure of Silicon Valley Bank. And if you also think the Fed is closer to the end of this tightening cycle, then interest rates will now be a tailwind to the value of bond portfolios at banks instead of the headwind that they were when they were on the rise, and as we said earlier, were a contributing factor to the cause of this crisis. And then the last point supporting our longer-term optimism runs sort of counter to consensus thinking. And that is that while investors tend to shy away from sectors where the companies are likely to be more heavily scrutinized by regulators, and additional regulatory scrutiny, make no mistake, is most certainly on the way here, the fact of the matter is that the largest banks in the country right now are generally perceived to be the ones that are most safe and sound. That was obviously not the case in 2008. So the regulatory actions taken with Dodd-Frank post the 2008 crisis, and those actions primarily targeted the largest banks in the country, is now helping to insulate those banks, those same banks in this crisis, to the point where they are perceived to be a real source of strength. What's likely to happen from this crisis is that many of those same standards that are in place to regulate the largest banks are likely to be extended down to the next tier of banks. And so while in the near term that involves higher expenses, higher capital requirements, ultimately the outcome is increased safety and soundness for the sector at large and a lower cost of capital, which ultimately bolsters the long-term investment case for the sector. Again, we are happy to talk in more detail with anyone on this topic and also as it relates to our investment fund. Thanks very much for listening.